so any move against you, you're really gonna feel it as well. While like when you're selling a put credit spread, if it moves against you, it's fine. I mean, like you're gonna have you know what your outcome is gonna be. You can pretty much project what you're gonna make month to month when you're selling put credit spreads, as long as you get the opportunities to redeploy your capital um, in an efficient manner. So say actually I'll just go pull up some credit spreads, and I usually start with about a month out, and I'll show you guys what I look for in just beginning to deploy capital. As you guys can see, like this account's like 15 grand. I only have 3,000 deployed. I think I had this account 2 weeks now, and it really wasn't a an ideal area to start really deploying and getting aggressive. I think we were somewhere in here, but I was able to sell like 2,600. So I mean, I was fine with deploying a little bit. I think I deployed 20% of capital, and I think we're like 1% up on the account. It's not a big deal, nothing crazy, but I'm really looking for like a significant couple red days before I get aggressive, and I'll really get into what I look for using VIX. Just to give you a heads up, I use the VIX to find certain levels where I start to deploy. Actually, you know what? We'll just start with the VIX. May as well. So, as you see here, I have different levels mapped out, and they're all pretty significant. We haven't seen any really like super low levels. Eventually, the VIX will be down in here, and then it'll be down in here, and I'll have to probably change not the strategy, but I'll probably have to watch for different levels where I start to deploy. Instead of right now, I'll deploy maybe some here, and then this is where I'll start to get more aggressive when it spikes up to here, and then up here, like I start to really get aggressive because it's kind of rare that it gets to this point, and if it ever gets here, that's like you know it's pretty easy because you can automatically assume that it's going to revert back to the lows pretty quickly, just like it did here. It spiked up, it tried to spike again, and it got rejected really hard, and it just continued to get rejected. And that's just how the VIX works. It always reverts back down to the low. But say for instance it reached this 31 level. I usually look for like an SPX set of contracts, like say like 30 days out or so. I mean, I'll go for I'll go for something like this, like 32, 28, 25, somewhere within that area. And usually it's whatever has the highest implied volatility within that little area. While like this one, you're shaving off like a good week if you went with the 25, and you're still getting higher implied volatility than the 28 days. So I'd probably just go with the 25. Open up a vertical credit spread, put credit spread, and I personally, I sell around 90% probability of profit, which also shows out of the money over here. And 90% probability of profit on puts lately has been like 85, 86% out of the money for those that don't use Tastyworks. I use Tastyworks because I mean it's really the best option platform in my personal opinion. And I learned a lot of this through the people that made the platform, so I just stuck with it. But in regards of risk, I mean, if you're starting with I would say if you're starting with at least 500 to a couple thousand, I'd probably say actually probably at least 1,000. I would use the SPX. And with this, I mean, you can do $500 spreads, and you can expect like a $50 return, which is 10% on a month, or 25 days a month, whatever. And I mean, if you have more capital, you can increase the spread. Your max loss goes up, but your max profit effectively changes within the same range, about 10%. But I usually sell at about 90% out, which I'm starting to think that might be a little too conservative lately, because we've come nowhere even close to any of my spreads even in the instance of this major pullback, I ended up actually selling a spread up here that and I ended up selling more as we fell, which was fine. But this one up here, I ended up selling like at 2,900, and as we started to come down, this was a little spooky here, so I ended up actually taking that spread, even though we never came even close. I ended up rolling it lower to like the 2750 or something like that, just because, I mean, why not, just to be safe. And I effectively ended up breaking even on that spread because I ended up having to take a $100 loss in exchange to make $100 back by rolling the spread lower. So, it was worth it to me. Nobody wants to really take, nobody wants to take a loss, and if you can be conservative and, you know, keep from, losing any capital, why not, right? It's not a big deal. But that's probably the closest thing I've had to a loss selling put credit spreads this year, is just, break even, which is pretty great. Let's see. But yeah, in regards of, spreads, I mean, it really depends on your risk, if you're starting with 1,000 plus, I would say you could use the SPX, and you're looking at 500 a spread. You're looking to make $50 for the first month. But what I want to also get into is, as the VIX starts to squeeze up to the next levels, say we reach this level, then I start to get a little more time aggressive. So if we were to reach this next level here and then beyond, what I would end up doing is I would actually end up selling with less time, 90% out still. So like, say I ended up going with like the 32 day or one of those, I would end up reducing my time on the next level by a week. So if I end up selling at 25 days, I would end up selling at like 18 days on the next one, and I would do the same exact thing. I would roll this higher to 90% probability of profit, and I would expect to collect about the same amount with less time, which effectively increases your annual return or your monthly return, or both, whatever. And basically, if you were to make 10% on a 1 month spread, and then 10% on a 3 week spread, 10% on a 2 week spread, and then, I mean, I probably wouldn't go as far as a 1 week just yet until you're like really experienced. But I mean, if you were to average your return as you redeploy that capital that you're getting back sooner, your average would go from 10%, even though you're collecting 10%, you're redeploying the capital and you're effectively collecting 15%. You can get 12 to 15% that way. So you're getting an average of basically, a redeployment of the 10% each time with less time. So you're effectively increasing your annual rate. And a lot of people don't really pay attention to this, but I mean, if you paid attention to compound interest per year, if you were to compound 10% per month for 12 months, you would end up gaining like 220% from the year. And a lot of people think 10% per month is 120% per year, but they forget about compound interest, and it's an extremely large factor in how well this plays out for you. But let's see, what else is there to cover? Oh yeah, SPY. So if you have less capital, you can do the same thing. You can come over to the SPY, and for the first level that we reach, so we reach this level right here around 31. And I mean, if you guys want to, you can screenshot this. I mean, this is everything I have mapped out. I'll actually go to where I actually really mapped this out. I went pretty far out, and I looked at levels where there was significance in time. This is like 1 month per candle, 20 years out. And as you can see, like it hit this. I kind of expected this because it always seems to do the same thing. Spikes up, hits that around that level right there. I kind of expected it to hit that, but it didn't. And then it just rolled over. And we can probably expect it to come back down to here. Eventually, it will come down to here sometime. But if you want to do the same strategy with less capital, I mean, you can have a couple $100, and I would recommend starting with probably like 300 to 500 if you, I mean, if you want to test this out with like minimal capital. Each spread, I believe, is like $100 versus the 500. Actually, wait. Yeah, so what happens here is like as you get further out, the spread between them starts to get wider. So like you have you're looking at about a $1 difference between up to 293, and then it jumps to 300 right here, and then 500. So you would be looking at like 86% probability profit, which honestly in the long run it might be fine, honestly, because I've never really come close to having a loss doing this, and I think over time I'm going to be a little less conservative, as you know, I guess I gain 100% confidence in the strategy, just because it's, you know, I've only been doing this for 8 months with this strategy, and I mean, so far it definitely seems like you can trim off a little, you can definitely add a little more risk there and for more profit. So, but I mean, if you started with $100, you would have $89 at risk to profit $11, which, I mean, it's not a lot, but I mean, if you're starting out, it's something. But the main reason I prefer the SPX over the SPY is because you're still going to have your fees, which are going to eat into your profit. So say you sold this credit spread, you're looking at a 200 or a $2 commission and a 29-cent fee out of your $11. You're effectively gonna collect $8.71. When you close trades in Tasty Trade, you're not paying a commission, so it's just gonna be that two. I think you might still pay a fee, but which isn't that big of a deal. But I mean, you're reducing your total gain out of this by a pretty significant amount. I mean, if you're talking about at the end of it, like $2.50 out of $11, you're effectively talking about like 15 to 20, probably 20% of your overall profit. So I mean, it's pretty significant. So I mean, if you can, maybe even, you know, consider just waiting till you have at least 1,000 in capital before getting into it, and just going to the SPX. And honestly, I mean, might be best, because I mean, you're definitely taking a good chunk of your profit out of this for the amount of time that's put in, you know. But I want to go ahead and ask, does anybody have any questions about anything so far? I mean, we've mostly touched on everything, but I just want to see if you guys have anything you're curious about. How do you calculate worst case scenario loss wise? Um, so I've looked at like a post crash, and I've noticed that usually you're not really gonna get more than a 10% pullback. Like I don't think I've really seen like, would this be a 10%? It's actually a pretty significant one. Let's see, 137 to 110. Let's see. Yeah, so that is pretty significant. I usually try to sell around 10%, 10% away from like the recent high. Lots of you looking to enter spreads, and you're only doing SPX spread. Yeah, so like I'm really only looking to enter positions when the market is going down. As it's going up, I don't really have an interest in entering. I want to wait for some kind of pullback, even if it's like it doesn't have to be like super significant. If I would say like the less significant it is, the more time I give myself in that spread, which is also going to put you further down away from what's going on. So like you're not only are you getting more time on your spread, but if you were to compare a 1 month spread, let's say we went 90% on this 30 day, and we'll compare it to, actually go to the VIX or SPX. So let's say we went to this 28-day vertical. We went 90% on this. You're looking at this is where your 90% probability of profit is, and it's, I want to say we're looking at almost three, or a little over $300, which is, I mean, it's almost 10%, which is not bad. But I mean, I wouldn't really be selling right now while it's making, it's on the way to making all-time highs. So but if you were to compare this to, say, like let's go for like even just a week lower, that same 90% is at 29.30, which is like, I think it was like $30 higher, $25 higher. And then as you get even lesser in time, you go to the 2 week, you're getting even higher. Like how significant that move was. I actually thought it would be more significant on that 1 week move than it was. But I mean, now you're talking about only 200 points away with the 2 week. I would definitely not recommend, selling anything but maybe a 1 month in our current climate. You definitely want to be selling as it's like on the way down, because that's when implied volatility is spiking, which is what the VIX is all about, implied volatility, and that's really that's really what it's all about. You want high implied volatility in the market, because as implied volatility rises, how far out you can sell your spreads increases significantly. So like this same position, if we were like way down here or down here, you would end up being able to sell a 2 week like all the way down to like the 2700s, which is like, and the market can only fall for so long. So like I think it's Haven. You were talking about worst case scenarios. So I mean, worst case scenarios, like say we pulled back this far already, and you started selling down in here somewhere. You're like, if you're selling down here, you're effectively going to be getting premium all the way down in like 2600. So you really don't have too much to worry about. And if you see signs that the market is really like about to roll over, I mean, you can always pull your position and then roll it lower later. You have like a huge margin for error doing this kind of trading. Your margin for error is like, it's ridiculous. It's mostly time based, and I mean, yeah, it's mostly time based. So I mean, like, as the market goes against you, you'll see it. I mean, you'll see days. I have days where it shows red, but I mean, as time goes by, ultimately theta wins. As long as we don't reach that point where the spreads are being traded, everything's. I mean, every briefly, it'll end up reversing back up, and you'll have recovered your delta gains. But on top of that, as that time went by, you can be in the same place you were a week ago, the same exact spot, but you'll notice that you're in profit because of the theta decay of the contracts. That's what's so great about it. What's the consistency for being in a 2700 put spread and SPX is ripping down to 250? 750. What's the contingency for being in a I mean, you can roll your spread lower if you really want to. Um, I haven't been. I mean, I really haven't been in a position where I really should have rolled a spread. I did one time so far, and honestly, I mean, it was trading 70 points above where my spread was, and I just didn't want to take the risk because I mean, I've been really conservative with this market lately. I just rolled it lower. Um, Essentially took the loss on the current trade, and on the next trade that I rolled it into, I made it back. So I mean, you could do that. Um, that's one way to go about it. Or I mean, you could ride it through. The thing is, like, if you still have a lot of time, the market is probably going to reverse at some point. And then as you're closer to expiration and it's reversing, you're going to quickly see profit, if that makes sense. So basically, delta and theta are working together along with your gamma. So I think I sold my spreads that I currently have open like right here somewhere. Yeah, it was like right here. It wasn't like the best in the world, the best entry in the world, but I mean, even if we rolled even if we rolled back down to test this level here, which I mean, as a trader, I mean, you can watch for levels too. I mean, there's not like one particular instance where you would decide to roll your trade lower or whatever. I mean, you can make decisions as a trader. You know to watch for levels of support and resistance, and say like we broke down through this 3,000 level. I mean, I might consider rolling my position lower or just closing it. I haven't had anything like that happen where I felt like I needed to do that yet. But as a trader, you might make an executive decision to do that. But so far, I've been pretty confident in just watching, really honestly, just watching the VIX. And I mean, even here, I think I sold a spread like here, and it spiked higher. I really wasn't worried because I knew like it was extremely likely that it could hit this level and it would just reverse, and it didn't even make it. It reversed, and it's just been trending down now. Sure, it could spike back up, but I mean, if the higher you sell in the VIX, I mean, really the better, because volatility can really only sustain for so long, and it's usually very short-lived. That's why I really like this strategy, because it's really easy to time your entries with the VIX, and you can be pretty certain that it's just going to revert back down. And as the VIX reverts down, that's when the market goes up. Something people don't realize is the market reverts up due to lack of volatility. The natural state of the market is to go up. Not even a joke. The natural state of the market is to go up, while the natural state of volatility is to go down. So while the natural state of volatility is to go down, you can watch the VIX to, reach certain levels, sell credit spreads a fair amount of the way out, and then you can expect the market to in turn around. So I think that's everything on credit spreads that I have off the top of my head. What's the probability of profit on a 2950 credit spread a month out? Let's check. Okay, let's see. 2950. 88%. So I mean, it's not a bad trade. But then again, I mean, um, we're where we're trading right now. I mean, it looks like honestly we're probably gonna break out. We're probably gonna shoot for 3,400. So I mean, it really is probably not bad. And also 29. We never even seen 2950 recently, so it might not be a bad idea. So it's not too close for me to consider. I mean, like I've sold just below support before, but in the way I personally trade now, I'm very strict in waiting for pullbacks. I'll have like small positions out there, but before I like go crazy in deploying capital, I usually like to see like decent pullbacks, decent red. So like something like this or this or this. I like to see that because implied volatility spikes really quickly, and you can get into a really good position really quickly, and then next thing you know, the market's reverting back up. And I honestly I wish I knew that years ago. I wish I knew that like the market went up due to a lack of volatility, and its natural state is to go up. I mean, people say it all the time, and I used to think it was kind of a joke, but it really is the truth. The market rolls upwards due to a lack of volatility, and down due to volatility. And all you really have to watch for if you're like trading the overall market is the VIX. And then if you compare them side by side, and you'll get a pretty good idea of what's going to happen. But I think that's pretty much everything on the subject today. You guys have any more questions for me? I'm happy to answer anything. I don't have any specific days. If I see an opportunity on a Monday, Tuesday, Wednesday, Thursday, Friday, any day, any day an opportunity presents itself, I'll go for it. I mean, it's really all about what the market's looking like. I usually like if it's a significant pullback, it's great. Obviously, you don't want to see something like this. I actually had positions open with this, and I was able to close them. I think I ended up closing them like somewhere here, and I took a small loss. I mean, it wasn't small. It wasn't like account blowing either. Really wasn't like too bad compared to probably what most people experience. But I ended up like closing somewhere in here when everything started to go to hell. Actually, it might have been up here because that was a pretty big drop. Yeah, I think I started closing here because I think my puts started getting tested. But I was doing iron condors at the time, and I think I was gaining like 50% a week, which is just like ridiculous. But um, at the time, selling calls what really wasn't too bad. It was worth doing at the time. Now I don't even touch calls. I might buy a call on a pullback to supplement my credit spreads, something small, but I don't really touch calls too much. But I don't. There's no particular day or week or month that I look to deploy capital. It's really all about what's going on in the market, what's going on in the VIX, and you know comparing the two of them. I will look for like what are they called, divergences in the MACD. And I know a lot of people despise the MACD or just don't like it, but I'll look for like things like this right here. you can see that it made a lower low while the MACD did not make a lower low, and that's called a type B divergence. And I'm pretty sure I ended up starting a personal position here. This account's not my account. This is somebody else's account that I'm trading for them. But I took a personal position like here when it started to revert back up, and I do watch for divergences as well. But that's like a whole different subject there, which I'd be happy to cover another day. But that's only going to increase the accuracy of your entries, you know. So like sometimes if I see a divergence, I'll definitely take it. But I mean, little things like that are we going to differentiate how much, you know, what your returns are going to be like, you know. So let's see. All right, Javen, do you have any questions for me? Anything else? Okay. And Christian, anything else? Yeah, no problem, man. I mean, honestly, like this really, I'm probably gonna end up doing another one eventually. This one wasn't super planned. This was supposed to just be, you know, a little one-on-one. I didn't really have anything planned out. I really just wrote down some bullet points to cover, and eventually I'll probably do another one that's more planned out, and I'll probably make some videos covering it more thoroughly. I'll probably end up posting the recording today sometime. And Fuzzy, do you have any questions for me? And also, if you guys have any questions later, I mean, anything crosses your mind that just didn't hit you now, just feel free to send me a DM and I'll be happy to help. Yeah, I could definitely record when I end up taking another trade sometime. I don't know if I'll see another opportunity probably for at least another week, honestly. I'll probably end up just letting my current positions reach maturity, collecting profit, and then waiting. It'll probably be a little time because we're squeezing up right now, and where I entered, I really didn't feel comfortable deploying too much capital. Do you deploy 100% on VIX spikes? What do you mean? Like all my cap? No, so like I'll do it in like increments. So like you know, I might do like a I might do like 10% at each level. If it comes back down and then retest that level, I might do another a little bit more. But I mean, I would say compared to like most traders and investors, it's a pretty significant amount in percentage wise. But I'm very confident. I am fully invested sometimes, like my own personal capital. It just depends. But I don't do it all at once. I usually like I'll wait for a level to hit, and then I might deploy a little more as we retest that level, and then once we break through to the next level, I might deploy more. It's usually like I make my way into it, but there are times where I'm fully invested. Yes. Yeah, I definitely do a lot of scaling in, and I'm always watching what's going on, and you know if there's any like red flags, I may get more defensive. Sometimes I may take profit early on some trades. to reduce my risk sooner. Um, but yeah, there's various ways where like you can just take profit earlier. You can just close positions that if you feel like you don't feel comfortable with how the market's trading right now. You know, these are things that I think you really just develop over time. There's a lot of like movement in the market that you really see, and it doesn't really make sense to you until later on. Like I had to unlearn a lot of like movements like that I would pay attention to for breakout trading during day trading and whatnot. When in my early days, I had to unlearn a lot of that in order to trade. I'd say like the best I can in longer time frames. But yeah, yeah, scaling is the way to go, because also like say you didn't scale in the market were to you decided you like this level here, for instance. You went all in. Yeah, I mean you'll probably still be fine, but you're gonna have that uncertainty as the market starts to roll over lower, and you see red on your P&L. It just doesn't feel good. And so if you can scale in, it'll just sit way better with you. You really just want it to be. The whole point of the strategy is really just to um, it's supposed to be kind of like so you can enjoy your day-to-day life. It's not supposed to be stressful. you know it's really supposed to be like a stress-free strategy, really. And on top of that, I mean you're beating the market like 10 times over, probably a lot more than that, probably like 20 times over. So I mean I would be conservative and understand that like if you're making 7 to 10% a month even, you're going to do extremely well over the next couple of years. Yeah, exactly, dude. 8% a year is like people think like 8% a year is like great, but once I realized that people are making so much more doing like things like this, I started to think like, man, how much are these institutions really making? If I can do this, how much are they making? Because I mean, there's no way that I'm smarter than these guys, right? So I don't know. They say they're happy to make 40 to 50% a year. I don't buy it. I feel like they're pocketing under the table a lot of extra money or something, because I mean 40 to 50% is like in a year. I mean I feel like it's extreme. It's like beyond doable. So, but as you can see, I mean it's really not that complex. Any other questions for me? All right. Good. Good to hear. I mean, yeah, no problem. Happy to do it. I love sharing. You know, it doesn't take away from me to share, so why not? Yeah, not a problem, guys. I'm gonna go ahead and end the session here. It was a pleasure to share with you guys today. I'll probably have another session another day, and I'll definitely let you guys know. And hopefully it'll be more polished next time. I mean, I think yeah, it was fine today, but there might have been things that I missed, little tidbits here and there that might make a slight difference, but I think you guys got the gist of it. But you guys all have a great day. Appreciate you for showing up, and look forward to next time. Yeah, no problem. Take care.